A shadowy world map appears, covered in lines representing national debts connecting every country. A narrator poses the question, if every nation is in debt, who is the creditor? A montage of news headlines about national debts, financial crises, and government bailouts. A visual of a maze, symbolizing the complexity of global debt. A timeline rolls back centuries, showing early civilizations trading grain and gold, with debt as a rare occurrence. A farmer hands grain to another farmer, representing personal debt in ancient times. A merchant exchanges gold with a trader, illustrating early forms of debt. A king looks worried as his treasury runs dry due to war expenses. Private financiers approach the British Crown with a proposal to lend money. The founding of the Bank of England in 1694, with bankers and officials signing documents. Financiers receive interest, privileges, and the right to create banknotes. Citizens pay taxes, indirectly funding government debt. The idea of central banking spreads. Scenes of the Bank of France in 1800 and the Federal Reserve in 1913. A web of central banks forms, each adding a new strand to the global debt grid. Money is shown as gold coins, then morphs into paper notes, and finally into digital numbers. A ledger is filled with numbers, symbolizing the creation of money through credit. A dollar bill transforms into an IOU, representing money as debt. Banks issue loans and new currency is created out of thin air. The global economy becomes a web of interconnected IOUs. Post-World War II reconstruction, nations scramble for funds to rebuild infrastructure. Delegates gather at Bretton Woods in 1944 to design a new financial order. The creation of the IMF and World Bank is depicted. A globe spins, with lines connecting nations to the IMF and World Bank. Loans are offered to nations, with conditions attached. A government leader signs a loan agreement, while advisors point to policy changes. National policies shift under the influence of creditor institutions. The US dollar is presented as the anchor of global finance. Other currencies peg to the dollar, and international trade is conducted in dollars. The US prints dollars, exporting debt globally. Demand for US Treasury bonds rises as nations seek dollars. Private banks expand, multiplying credit through fractional reserve banking. Governments, corporations, and citizens all borrow, feeding the same debt machine. Credit is created not from savings, but from expansion. Debt becomes the bloodstream of capitalism, fueling growth and dependency. The 1970s, the debt grid grows to large and complex. President Nixon announces the end of the gold standard in 1971. The last tie between money and tangible value is cut. Money, credit, and debt become indistinguishable. Governments issue bonds without restraint. Banks create unlimited loans. Consumers buy homes and cars with borrowed money. A graph shows global debt skyrocketing from $15 trillion in 1972, over $310 trillion in 2024. Inequality rises, asset prices inflate, and wages stagnate. Nations struggle with interest payments, becoming trapped. Economic crises become cyclical, not rare. A nation tries to escape the debt grid, facing the debt trap cycle. Country borrows for development, encouraged by international lenders. Debt grows faster than revenue due to compounding interest. The country returns for more loans to refinance old debt. New loans require structural adjustments, cutting social programs, privatizing industries, devaluing currency. The nation becomes more dependent, not less. Latin American, African, Asian, and European countries experience debt crises and austerity. Countries lose economic sovereignty, forced to satisfy creditors and investors. Natural resources and infrastructure are sold, or at least as part of restructuring. Dependence, not force, maintains the debt grid. Policymakers attempt bailouts, austerity, stimulus, and quantitative easing. None of the fixes work long-term. Debt continues to expand. Austerity slows growth, worsening debt-to-GDP ratios. Borrowing more extends the timeline, but doesn't solve the imbalance. Printing money inflates asset markets and increases inequality. Interest rate manipulation leads to bubbles or collapses, but debt grows. Restructuring offers temporary relief, but interest compounds again. The system has no off switch or reset button. It only expands. Global debt doubles every 10 to 12 years, shown on a timeline. Major economies spend more on interest than on education, infrastructure, or defense. Countries adjust policies for markets, not citizens. Economic crises trigger more borrowing, expanding the grid. Private debt mirrors public debt. Households, corporations, and financial sectors borrow to maintain growth. If global debt shrinks, the money supply contracts and the economy implodes. The debt grid persists because it cannot shrink without collapsing. 3 pillars of the debt grid are revealed: money as debt, interest-driven expansion, and structural dependence. Nations rely on global capital markets, multinational creditors, and central banks. The system is designed for continuation, not escape. Debt is manufactured, distributed, and monetized like a product. Nations orbit around debt obligations. Policy is downstream of debt. Reforms tweak the edges, but the foundation remains unchanged. Transformation requires rethinking the core structure of money. The global debt grid is shown as a visible system in policy decisions and financial markets. Momentum from trillions in debt keeps the system running. The real mystery is how long the system can continue before a forced reset. The narrator urges viewers to like, subscribe, and stay tuned for more deep dives into global finance.